No. All right, fantastic. So let's get this party started. All right, what a great day in the market. We're up and up and up, and things are looking good at the moment. Let's take a look. All right, let me shut this down a bit. All right, I've only got about an hour, so sorry we're late. Also, but I was trying to. I had not used this webinar on this laptop before. It's not a laptop. It's like a flat screen portable thing. It's nice. Anyway, so we got some bursting activity here. Well, that's a 5-minute chart. That looks very impressive on the 5-minute chart. Still impressive. Okay, so this is our bounce off 24,000, and if we go back to yesterday, we'll take a look at what the line should be. Whoops. Come on, baby. There we go. And this is what these bounce lines are good for, because you always want to see where things are. Let's see if we can pull the futures over closer to the thing. Oh, no. Nope, there it goes. Okay, good. Things are a little bit slow on the fabulous Sheraton Hotel Wi-Fi. I'm in California, in case you guys don't know. We're having a series of meetings regarding our investment in New Age Ventures, the marijuana company. So we'll see what happens. All right. So we were looking for 24.8, and the Dow is currently at 24.8. So that's perfect. That's a weak bounce, but that's where we failed yesterday. So it took us all day today to get back to that bullshit open yesterday. Now we'll see if we can actually sustain it for a change. But that's all that is a weak bounce line. So what's the weak bounce line on the S&P that we predicted? We predicted it would be, well, we're not even there. It's 2710, 2640 to 2710, and so the Dow, of course, is the most bullshit index. So the S&P isn't even close to its weak bounce, which is up here. And 2640 was the bottom. Oh, well, it's not the bottom. 2640 is a 10% line. That's what the problem is. So that's 10% off the top. Oh, why is this so slow? Yeah, 2640 is 10% off the top. So anything below that is really dead, and we were a bit below it, and it was looking like it was very dangerously looking like it might be a ceiling. But we did manage to pop over, consolidate a bit, and now we're moving back up. But still, it's not even a weak bounce until we hit 2710. So the Dow is only 30 stocks, and they have ridiculous. It's not market cap weighted; it's price weighted. So in other words, a $100 stock is 10 times more important on the Dow than a $10 stock, even if the $10 stock has a bigger market cap than the $100 stock. So it's completely idiotic. So never go by the Dow. It's not a good indicator of anything, and like one or two stocks can just throw it all over the place. The S&P obviously fairly reliable. The Nasdaq Russell a little more reliable. They got lots of stocks in them, so you can pay attention. The problem with the Nasdaq though is it's heavily Apple weighted. So when you're looking at the Nasdaq, you're pretty much looking at what Apple's doing. When you're looking at the S&P, it's 3% Apple, but that's not horrible. But Apple also has a significant effect on the S&P, and it's Dow component, so it has a significant effect on the Dow. So Apple, when Apple moves, the whole market follows it pretty much, except the Russell, and the Russell does its own thing. That's why sometimes you'll see the whole market go up except the Russell. You say, oh, there's something wrong here, because the Russell is the non-Fortune 500 companies, the small, the small caps. So it's actually even below. It's below like the S&P 5000. There's another couple of thousand companies. Not the 5,000. I'm sorry, below the S&P 1,000. What would be the S&P 1,000? Or below the Nasdaq 2,000. But some of these are cross companies. None of these cross. So the Russell and the S&P do not cross. The Nasdaq and the Russell cross. The Dow and the S&P are entirely. The Dow is entirely included in the S&P. So because these are the 500 largest companies, and these are 30 of the largest companies. So really, looking at the Dow is completely meaningless. Meanwhile, I guess it's 1 o'clock for you guys. So the Europe is obviously closed. They had a 1.8 day on the Euro stocks, and and a 1.39% on the DAX, so they're moving back up a bit. 3,000 was the key bounce on Euro stocks. Let's finish these up, and then we'll take a look at what Euro stocks should be. NASDAQ 6870 was the 10% line. So where are we now? We're at 6862. So see now here, this is the minus 10% line right where we are, is the minus 10% line on the NASDAQ. And we're not even over it. We're halting there. You don't want to halt there. That's a terrible sign. But that's what the S&P did over here. We halted there, and it took a bit to go over it. So it's not that likely we're going to just punch through on the NASDAQ. All right, so be careful of that. And did I mention I'm leaving in an hour? I think I did. So I'm not going to be here for the end of the day. Russell 1485 was their 10% line. Are we at 1485? No, we're nowhere near 1485. So the S&P is not even at a weak bounce. The NASDAQ's not even back to 10%. The Russell is not even back to 10%. There's nothing good about this. I don't give a shit that the Dow's up 400 points or that all these guys are up 2%. They were in incredible trouble. Up 2% doesn't get these guys back to the minus 10% line because they were down 12% before it happened. That's not good. Okay. So don't start reading into it that this is some great day or anything like that. This is just it's better than being dead. That's all it is. It's like stages. Like a building falls on somebody, and you're like, "Oh my God, he's dead!" And then it's like, "No, he's just in a coma." And you're like, "Oh, thank God, he's just in a coma. He's critical condition. Oh, thank God, critical condition is better than dead." That's where we are right now. We're not dead, but it's not good. So don't get too carried away with these bounces. We are playing them for bounces, though, because again, we've shown support. Let's move to a daily view. We've shown support 3 times at this level. So we don't think that something's going to happen that's going to plunge us all the way back down in one shot. We think if we're going to come back down, we're probably going to at least pause here. So since we took our hedges off here, the TZAs, we took our hedges off at these lines, which are fairly strong support lines. Logically, we feel that we'll have a chance to put the hedges back on if we cross below those lines. So hopefully that's what the case is. Now, of course, we took the hedges off. Should the indexes really rally back and start making some serious progress towards the strong bounce lines, and the strong bounce lines are miles up. They're up here. They're up here. They're up here. We're nowhere near bounces. You'll need all of next week to make a strong. Oh, and this is a daily chart. So how many sessions did it take to drop? 1, 2, 3, 4. All right, so we've got 4 sessions, including today. We have 3 more sessions tomorrow, Monday, Tuesday. So by Tuesday next week, we need to be back here, or it's a failure. We need to be back at these highs, or this is a failure, because that means we'd be making a lower high, and then that would set off a cascading signal. And what you're doing is stair-stepping down, which is often the way you fall in a market collapse. You don't go straight down. You go bit by bit by bit by bit. It just keeps going lower, and every time it goes lower, people are like, "Oh my God, I can't believe it, but now I'm going to buy this, and now I'm going to buy that." And they keep making mistake after mistake after mistake trying to jump in on stocks. Okay, we're hopefully not going to do that, but just in case, because you have China has an interest in stimulating. The way we held up on Monday made me want to be less bullish, because I'm like, look, they're obviously pulling out all the stops. China's willing to say shit. America's willing to say shit. Everybody's trying to support the economy, keep it from falling apart. The European Union tomorrow is making a rate decision. Our Fed is making a rate decision next week. There's so many things that can influence the market, and I get the impression from the Fed that nobody wants to see the market collapse. And so, given that premise, then the Fed's going to make a decision based on what's it going to do to the market. And I think possibly that since we're coming into, what's today, like the 11th? So 12th. It's my dad's birthday. Happy birthday, David Davis. He's not alive anymore, but, Wow. Okay. That's freaky. I didn't realize it was his birthday. Huh. Where was I? Oh, yeah. So given that next week is going to be the 19th on Wednesday, and that'll be the Fed decision day, and Christmas is a week later, not even a week later, I'm not sure the Fed wants to crash the market for Christmas. So even though they should raise rates, and I think they're going to damage their credibility if they don't raise rates, I think that they might not raise rates because it's freaking 6 days before Christmas. And could you imagine the repercussions that they will face? I mean, these are people. They go home, they got families, they talk to people all the time. They have to have these meetings where they sit in front of tons of business people all the time. They do those beige book reports are them talking to businessmen in their community. That's their job, as they go around and they talk to business leaders in their community. And can you imagine how pissed off all those people are going to be if 6 days before Christmas or 5 shopping days before Christmas, the Fed tanks the market and destroys the Christmas shopping season and puts everybody in a bad mood? And Trump will blame them for the entire year being destroyed? I can't see it. I think they're not. So at this point, I'm starting to think they're not going to raise rates. And then we could have a big rally off that. And look, everybody wants that. Everybody wants a Santa Claus rally. Everybody wants the markets not to be down for the year. And especially the people in power. So I think it's a good bet to say it won't happen. I think coming to that 10% line and not going lower and recovering so quickly makes me think that there's enough effort and enough of a push behind this thing that we can take it up. So that's my logic in what we did as far as pushing longs on the portfolio adjustments, and we'll see what happens. Robin says, did I do disclaimer? No, I didn't. Okay, everybody has to read the disclaimer at philstockworld.com/ I think it's called disclosure, actually, not disclaimer. So yes, I'm advising you now to read the disclaimer because I didn't do that and I don't have it up here. Thanks, Robin. Also, infrastructure possibility. Do you like EME MCOR? I like MCOR, and I would definitely like them if we passed an infrastructure bill, but did you see Trump and Pelosi talking yesterday? I don't see how they're going to agree on anything. Oops, what's going on here? Because EME, and by the way, I don't want to start doing a whole bunch of new stocks because we can talk about some more. We have some serious old stocks we should be talking about right now. But MCOR is a good company. They're valued at under $4 billion right now. And they have no income statement because unless Yahoo's going to fill it in a minute. No, they don't. Okay, well, they have no income statement, which is not very helpful. But anyway, they're a good company. They've at $4 billion. I'd say they're probably making about $2.5 billion, $3 billion a year. And with infrastructure comes back, and we start spending on infrastructure for a change, I think it'll do very well. So, what was the actual question? 1 second. Do you like EME? Yes. So yes, I do like it. And if you remind me tomorrow in chat, I'd be very happy to figure out a good trade idea for them. But probably just selling some puts for now. I was looking at. All right. Rob says I was looking at your NLY comment earlier today. Any suggestions for new positions to add NLY to my portfolio? Yeah, sure. I always like NLY. You guys, if I click here, can you guys see? Oh well, no, it's not NLY. Can you guys see my other screen? If I click on my other screen, or it doesn't work like that? I'm guessing not. Instead of doing anything complicated, though, I'm just gonna NLY. I'm just gonna go over there and tell you what I see. So NLY is currently at $10.03, and you want to buy the stock because it pays a 10-cent per month dividend, so you don't want to miss that. You can sell. It's not that attractive. You can sell the $10 calls in 2020. Oh, forget that. No, these are ridiculous prices. The next year, the $10 calls are 35 cents. So why would you rather be? Yeah. All right, well, I'm just telling you that. So trust me. Next year, the $10 call. Actually, you shouldn't trust me. I'm notoriously bad about mixing things up. But I'm telling you, I'm looking. So the next year $10 calls are only 35 cents. Why would you sell those? It doesn't even make sense right now. So that's why we didn't cover them in the portfolio, because we said, you know what, if it goes up, then we'll sell some. If it goes to 11 or 12, we'll sell some, because then we're happy to cover, because that's a good profit. But 30 cents, why would I want to lock in 30 cents? It makes no sense, because I'm not saving enough money to make it worth my while. Now, on the other hand, though, I would go out to 2021. Well, I see that in 2020 you can sell the $10 puts for $1.15, but in 2021 you can apparently get $1.80. I would rather take the $1.80, and the reason I'd rather take it is because an assignment's an assignment. So if it goes down to $8, you're going to get assigned either way. And your net assignment is the difference. Is going to be your net assignment. Your net assignment is what matters. So instead of having a net assignment of $8.85, you would have a net assignment of $8.20. So I'd rather have the $8.20 net assignment. So if you buy your first round of stock at $10, let's forget the 3. So if you do your first round at $10 and your second round comes in at $8.20, if you're assigned, then you're in for $18.20. So that's $9.10. So you're giving yourself effectively a 10% discount on the position if it goes lower. If it doesn't go lower and it goes up, then the $1.80 extra is just a boost to then your net entry is $10 minus $1.80, which is $8.20, and you're not even getting called away, but it actually it means you put in less money and you will get a larger dividend. And then when it goes to 11 and you cover with the $10 calls for $1.25, now you're locking in a much better game, right? Because it went to 11, then you sell the calls for $1.25. Then if you get called away, you've now reduced your basis down to $7. So if you get called away at 10, you're still making $3 more plus all the dividends. So it turns it into a monster play if you do something like that. And I did an example in chat, which I think we should talk about. So hang on, I'll show you what we were talking. All right, we talked about that. Oh, I did want to. Too many things. Okay, circling back to the Euro stocks, right? Euro stocks fell from 3,400 to 3,000, so that's 400 points, and that means you're looking at 80-point bounces. So the Euro stocks have popped the week bounce at 80, and the next one is 160. So we want to very much, and that's where they kind of gap down. So you want to watch this 160 line here. And here you got 12.5 to 10.5 is 2,000. So you're looking for 400-point bounces. So it'd be 10.9, which we're just popping over. And the next one is 11.3, also where we gap down. So these gap down points in Europe is what we want to see coming up. And that's going to give us an indication that we will also begin to recover strongly. Okay, and again, it's not going to happen today. Obviously, it's not going to happen today. They're closed. It's tomorrow's Thursday, maybe Friday. So by Friday, I think if you don't see these by Friday, we're probably going to want to hedge a little bit more until the weekend. I want to at least see these guys coming back to these levels, which are the strong bounce lines. If they make their strong bounce lines, then it's very likely that we're going to plow up to our strong bounce lines. All right, so that's that. Good, now I feel better that I finished that. All right, now. Oh, well, I used to only having an hour. I have to actually get to stuff, like I usually ramble. All right, let's see. Are we on that post? Okay, so we were just talking about this right before I started the webinar, I think. By the way, I would never choose to have a business in California. It took me over an hour to go like 15 miles yesterday. I was so pissed. Just insane. Traffic is ridiculous. All right, NOI. Here you go. So, what I like about NOI is they pay $1.20 in dividends, and they pay, I think, 10% a month. 10 cents a month, which is nice, and especially if you have a lot of it. I mean, think about it. If you put $1 million into MLY, it's going to pay you back 120,000 a year. It's going to pay you $10,000 a month to live on, like pin money, what my mother would call pin money. Not that she's super rich, just that's whenever she gets like little checks like Social Security or something like that, she's like, oh, good, because that's her party money that she goes and spends. So if you're rich enough, we have millions and millions of dollars, and one of your investments is this one, it throws $10,000 a month at you. That's not bad. That's a little cash in your pocket every month that you can go play with. And it's dividends, low taxes, and so on and so forth. So it's a very nice thing to hold as a part of your portfolio. Now, the math we were doing, though, that I was trying to show, and let's take a look at that. I love these calculators. All right, so it's not going to go up much because it's a REIT. It pays out 90% of its profits to the shareholders as dividends. So where's the growth going to come from? It's very slow to grow. And what generally these REITs they'll borrow more. They pay down their debts. They borrow more, and that's how they end up increasing their value over time. And then if there's like a housing boom or something like that, they end up sitting on some. Well, it depends on how they do it. In their case, if there's a mortgage boom or something good with the rates or whatever happens, then they're fortunate and they have a little kick up. These guys don't own property; they sell mortgages, buy and sell mortgages, really. They're not a property REIT. So, which is good and bad, depends on the time of year. But everybody's kind of freaking out about these guys that they can't handle the rates. But meanwhile, if you look at the history of the company and their management, you're like, that's what they do. Why do you think that rising? There's this very simple logic that rising rates are bad for mortgage sellers, but that's stupid because they're constantly selling mortgages, so they sell at the higher rates. They know what they're doing. They've got hedges in place. They've been doing this for like 40 years. It's like they're not suddenly shocked that rates change, and they've survived all these ups and downs of all these different cycles. Why would they suddenly not be able to handle it? So, so it's good. I mean, it's nice when you can buy them this cheap and get a good bargain. Not to say they won't go lower, but the point is, you really nothing to worry about in their books. Or here, take a look. I don't want to spend too much time on things. I only have a little bit, but so look. Well, I wouldn't even say steadily. All right, from here, nicely rising revenues. Okay. It's almost all profit because the revenues is the interest. And so it's the interest minus what it costs to run the company, which is not very much. And they collect all this cash. They have a net operating income of $1.5 billion, and then they distribute it. And all they're doing is flipping mortgages back and forth. That's really nice. And you can buy this entire company that makes $1.5 billion a year for $13 billion. That's a P of like 8. What's not to like? I don't understand why anybody doesn't want this stock. It just drives me crazy. And they do it forever and ever and ever. This is how they run their business. Here, let's do a chart. And let's take a look. Well, 5 years, okay. So look, here they are at 9. Here they are at 12. Here they are at 10, 12, 9, 11, 10, 12, 10. Who cares? Let's go back 10 years. Let's go back max. What's max? There you go. Now, before 2000, they were down in the same kind of range, a little bit lower maybe. Then they kind of went into favor when the bubble burst, the stock bubble, people started putting money into this stuff in the housing market and so on and so forth because we were encouraging housing and things were going really good for them. Then they went down and their thing burst and then they go back up and now they go down, now they're down. One day they'll be up again. It's just cycles. Who cares? What I care about, now we'll go back. What I care about is this. You go to historical data, and we show the dividends only for the maximum amount of time, and we say whatever, and we apply it. Doesn't matter if it's daily. Oh, come on. Really? There's no history? I'm upset. Stupid Yahoo. I don't even get what that is. All right. Anyway, so I'm sorry. They don't pay. I thought they paid quarterly, monthly, but that's ARR, not these guys. So they pay 30 cents a quarter. So anyway, you can look back very far, and it's 30, 30, 30, 30, 30. They're very consistent with their dividends. And here they paid, for some reason, they broke up their dividend. It's still 30. It's just they paid it in two spots for whatever reason. So that being the case, that you're going to constantly get your $1.20, right? So then you go to a compound rate calculator. Excuse me, questions. Okay. And now we go to compound rate calculator. And this is the point I was making. I'm like, look, so you have $10,000 worth of stock on $1 million, and you're not adding anything to it, and you're going to have, let's say, now next year, if it's 12%, if that's all you're getting on, well, I'm sorry, it's not 12%, because if you do the short put sale, right, the worst thing that's going to happen to you is you'll get another $10,000 worth of stock. So let's say you're doing a college fund for your kid, and you want to put $100,000 into your college fund. Do it over time. The trick you can do is, instead of adding anything, you just keep selling those puts, because those puts are going to add 10% every year to your sales. So now you're going to get, instead of 12%, you're going to get 20%, because you're selling puts. And some years you might get assigned, and most years you won't get assigned. But every time you get assigned, you just have more stock that throws off more dividends. But let's say you never get assigned, and all you ever do is sell the puts, and all you ever make is 20% on your original $10,000. Now, if you do that for 1 year, obviously it's $12,000. That doesn't seem very exciting, right? It's like, I made $2,000. How is this going to put my kid into college? But the trick is, when you let that grow 20 years, just 20% a year, 20 years, all I'm doing is changing the years, $383,000. Now, that's assuming you're reinvesting those dividends. Of course, that's compound rate. So you're reinvesting the $12,000, the $2,000 you make every year. You have that you do buy more stock with. So every year you would buy a little bit more stock. But there's your college paid for right there with just $10,000. So again, remember, I'm saying, you have to put $100,000 away to put your kids in college. So one way to do it is to invest in, let's say, 2 or 3 REITs like this. Put $10,000 in to start, sell some puts. If they go lower, you'll buy another round, but you still won't come anywhere near spending your $100,000. If they go lower again at some point, you'll buy another round. But then what will you end up with? You'll end up with $30,000 worth of whichever stock you put 2 rounds into. And again, you're putting it in based on the fact that it went down, but you think it just went down because of a cycle, not because something bad happened. But if you do that, and as you cyclically invest, what happens is, instead of now throwing off at a certain point, let's say you get to $30,000 and there's 15 years left, right? And they still are paying their dividends and you're still successful with your sales. Now it's $462,000 when your kid's ready for college. That's not hard. It's not a hard concept. I put money in a 501, I don't know, whatever they call those college accounts. But what I did is I put $100,000 in when the kids were, not when Maddie was born, when Jackie was born. I said, oops, I better put some money in. So I put $100,000 in both of their accounts in 2002. And Maddie just went to college, and she's got about $250,000 in the account. And you can only put it in ETFs, but it wasn't taxed, so there's an advantage to that, is having the non-taxable income. But you can set up an account and put it into a REIT like this also. But that was me laying out $100,000 from day one, and it's not that much if you think about it. But of course, we survived the crash, $100,000. And we didn't add anything. I never had to add anything. Even when the crash, it was down to like 40 something, and I was like, it'll come back. Well, not 40. I think it was like 50 something when we crashed, because we had made some gains, but then the market collapsed. And then so that in that case, it was not 18, 16 years to grow. We had 16 years. I think probably averaging about 6%. Yeah. So that's how my college fund worked out for the kids' for college. That it was a thing, and I wasn't, I mean, the point was to have the tax-free money. So I took $100,000, put it in the college account, and or 100,000 each, and now they've got $250,000 plus to play with. And I cashed that out last year because frankly, the college, there was no logic to leaving it in because in the summer, not last year, in the summertime, I cashed it out because the market was really high and they were over 250,000, which is more money than they need for any 4-year school they're going to go to. So why would I risk it? A 20% correction could knock out a semester of college. Why would I risk that? It doesn't make any sense. See, in that case, the risk reward became different because now it's like, well, you do have enough money to go to college. Here it is. So therefore, what nerve do I have putting that money back in the market and risking it? So unless I feel very confident that we've hit a bottom, because obviously in 4 years they could probably make another, let's say they make 25, probably make another $100,000 or they got to take some out, so on and so forth. So let's say they make another $50,000, $75,000. That would be nice. So realistically, if I can reposition the money and find something and find an ETFs I like to put it into, I would do that. Right now, I think something like the oil services, I think, is probably very cheap right now. I'd like to put it into the marijuana ETF, frankly. But the point being, though, that it's as cash, it's right now it's safe and paying for their college. If Madeline already started college, that's what she does. I don't write a single check for college. She takes everything out of that account. Anything she needs, housing, food, computers, anything, she just can write checks out of that account. So it's fantastic. And no tax, no nothing. It's done. When she has money left, now the funny thing is when she has money left, because you don't want too much, because whatever she's got left, that gets taxed like 50% coming out. So the idea is to try to have the exactly right amount of money, not too much and not too little. Anyway, so that's my story on that. All right. But that's why I think it's like so hugely great to have these kind of things. Oh, look, Dave and Buster's coming back way too fast. We wanted to kind of play that. Rob says he can't see the other screen. Yeah, we know that. Oh, I'm sorry, that was from before. Okay. What else did we talk about today? We had some good plays today, and we've got 20 minutes to go over them, so let's go over today. What has been going on? First of all, we got the chart, and it's drastically different now because the Dow's up 400. It was 24, and now it's 28, which is right there. Still below, obviously, until we get over the 25,000. It doesn't mean crap. You're going to death cross. It is almost, this is a 50-day moving average. This is a 200-day moving average. This thing's not going to move. Even if you go up here, this is coming down too fast. So it'd be very hard to move this up. You'd have to be way up here to avoid this blue line coming below the red line. And even if you are way up here, the blue line might start moving up a little bit, but then the red line will start moving up, and then you're going to be in trouble anyway. So you are going to death cross on the Dow. You've already death crossed on the S&P. So now you have to turn that to be really bullish. You've already death crossed on the NASDAQ. You've already death crossed long ago on the NYSE. You death crossed long ago on the Russell. We got these signals back in November. They were pretty obvious, right? And look at the line that they're following. I mean, look at this. You can see it's kind of following. It hit the 50-day moving average and died. And actually, Russell today is up at 75. It's bounced up, but still, it hit the red line and died. If the Russell hits the 50-day moving average again and fails, that's going to be a terrible sign. All right, and the same goes for the NASDAQ here. If the NASDAQ gets to 7,000 and fails, terrible sign. We're not going to have a good sign until we're over the 200-day moving averages again. That's going to be the first good sign that we get. So there's nothing to be too bullish about, but of course, there's also not much resistance until we get to the 50-day moving average. So it's pretty easy for us to get there. It's very disappointing if we can't get over it, but getting there shouldn't be that hard. There's very little resistance there. All right, so that was the big chart today. Somebody, iPlan, pointed out that we do have a lot of pictures of of Trump in our news. He does glare out at us constantly. I mean, he's the president, I guess. It's funny, though, because, when Obama was president, he wasn't the news every day. Obama was just the president doing his job. And that's why this is crazy, because we're not used to, like, every single freaking day, this guy has to be on television. It's like if he's not making noise, he doesn't have a fulfilling day. He wants to be constantly in the news. It's crazy. I mean, he does something every single day to be in the news, or more than one thing. He does dozens of things every day to be in the news. So there's constantly articles about him, and they're not unimportant articles. So I end up, when I'm reading my news, I end up tagging them because I tag anything that I think might be market moving or very interesting. Sometimes I just put something up because it's interesting or funny. So whatever I feel like, basically. But when I'm reading the news, and you guys, I read at least 4 times what I tag. You guys are only seeing the stuff I like. Also in the news, I guess you should probably know, it's, I'll tag something. Sometimes I'll tag like 3 articles on the same thing because I just think that 3 viewpoints are interesting and they're not always the same. And for me, I find it's very helpful to read different points of view, like from 3 different papers and 3 different writers. Sometimes I like to get a perspective on a story, especially if it's a major story of what's going on. It helps fill in the gaps a little bit. So it's not an accident when I put up more than one thing, because what I do is I go tag. Then before I publish it, I review all the things I've tagged, and then sometimes I'll usually try to pick the best of all the articles I read on a subject. I'll usually pick the best one, but sometimes I'm like, well, he had a point of view, and he had a point of view, and he had a point of view, and it helps fill in the details. So that's my logic for that. Oil, gas, everything's coming off the highs. Wow. That's a freaking shame. Natural gas even lower. Dollar still low. Coffee coming back a little bit. Last chance to get coffee. KC. I love it. KCN9 is what we're playing. And KCN9 is currently KC. What happened? What's going on? I think I lost my thinkorswim. I hope I didn't lose all my things. Check. Still sound and stuff? Yeah, still working. Oh, here it comes. All right. KCN9. Oh, no. KCN. No, I think it's N19 now. Sorry. Yeah, it's KCN19. It's at 108.85. So that's the July contracts. I really like the coffee trade, which I've said before, and I'll say it again because I really like it. And if natural gas gets lower, I'm going to really like that too. All right, marijuana. We ended up putting this in the long-term portfolio. It came back down. We got in over here, went up, and now we're back in over here. We didn't have it in the long-term portfolio, so I'm very happy with it right now. We took a bigger position than this, but the gist of it is selling 10 puts, the $30 puts, buying 20 of the calls, selling 15 of the 40. So not a full cover on the long spread. So it's $27.40, $13 spread. There's 20 of them, so it pays $26,000 if all goes well. We're covering with the April 32s, and they're $2. But obviously, you can roll the April 32s to the 2021 40s. So we're covering with a shorter time frame. Why? Because April is, it's 4 months out, but basically April's a quarterly sale. So if we can sell 8 of these quarters for $1,000 each, that's $8,000. Whereas 5 of these sells for $2,000. So we're getting $6,000 more money by selling the shorter term calls. But I don't want to do that. I mean, I don't want to do that. I don't want to risk it with all of it. But since we have a net $250 credit by doing it this way, there's absolutely no harm. Now, when you work a spread out to have a net $250 credit or a net flat spread, what's the advantage? The advantage is that my puts are my puts. So MJ is currently just under 30, and my worst case scenario is owning MJ for 30. So I like that. I'm not paying much of a premium to take this play. I'm paying $1. My worst case is owning it for $1 more than if I buy the stock now. But I'm using no cash at all. I'm using a little bit of margin, and my upside is $26,000. So love it. Totally love this play. What else was there? Oh, we like FedEx down here. We think this drop. There's this thing about Amazon, Amazon Air, and nothing has actually happened. All that happened is they kind of changed their name because they were called Amazon Prime Air, and then 3 years ago, they bought air transport stock, and last year they began building a hub in Cincinnati, which is just finishing up. So as the hub is finishing up in Cincinnati, Amazon changed their name to Amazon Air because Prime Air is what the drones are now called. So they don't want to make people confused. So Amazon Air is their new. It's the best way to describe it. Their new FedEx hub sort of thing that they're trying to do their own packaging and stuff. But you can't run FedEx. FedEx has 25 ground hubs and 12 air hubs. Amazon has 1 air hub now. They're not FedEx. They're not a viable competitor. That's like saying that that Shake Shack is a viable competitor to McDonald's. It's just ridiculous. Shake Shack has 100 stores, 200 stores. McDonald's has 20,000, 30,000 stores. It's a competitor, but it's not a competitor where you go, oh my God, McDonald's is finished because Shake Shack has 200 stores. That's stupid. And this is a problem. Analysts are stupid, and analysts are lazy, and investors have no sense of proportion whatsoever, and they don't think anything through. And all that happens is they say, oh my God, Amazon is turning into FedEx, and FedEx is dead. And people freak out and drop FedEx from $250 to $190. 25% drop in FedEx because Amazon has 1 hub. That's moronic. So, meanwhile, they got $3 billion now. Here's a big pet peeve of mine. You always have to be careful of this. And I think we talked about this last week. But when you're looking at financials, when you're looking at these companies, you cannot take anybody's PE ratios for granted. This says FedEx has a PE ratio of 10 at $50 billion. But realistically, if you look at the financials, last year they made $4.5 billion. But they made it because they took a $500 million tax credit on $5 billion of earnings. I'm sorry, interest. That's interest. This is a tax credit, $200 million tax credit on 4.3. That's what brought them up to 4.5. Normally, with $4.3 billion, they would pay $1.5 billion in taxes, and they'd end up with $3 billion in profit, just like here. So their PE is 50 divided by 3 billion, not 50 divided by 4.5 billion. And you've got to be aware of this because the Trump tax cut has made all these earnings look so inflated. And that's why, again, when you have these analysts, idiots, talking about earnings growth on the S&P, this is what they're talking about. They don't look at this. They give you this number and they say, oh, the S&P earnings are this and we're extrapolating next year they're going to do 4.5 again. No, you're not going to get a fucking tax credit every single year. That's idiotic. They have a tax credit because they were able to take advantage of the change in the law and generate a net credit, taking a whole bunch of stuff that now they don't have anymore for deductions. You have to be realistic about what you're going to make going forward, and these companies are ridiculously priced based on the premise that this is permanent. That every year when they make 4.5 billion, the government's going to give them 219 million and say thank you. Thank you for making so much money. It's not how it works. And all you got to do is watch that conversation with Pelosi and Schumer and Trump yesterday and say that is not how it's going to work in the future at all. And it's not because they changed the law. It's even the Trump's law is not written that way. They're going to pay 25% tax. That's normal. And they burned a bunch of deductions to pump up their earnings. That was what they did last year. They took advantage. And a lot of these companies are going to be in so much pressure to match, and they're not going to be able to match these numbers next year, and that's going to turn very ugly for them. So be really careful about this stuff when you're looking at these companies, and don't take anything for face value. You got to check it out yourself and see if it looks realistic. So what are we talking about? FedEx, right? Okay. So for FedEx, I'm enthusiastic, but not super enthusiastic because this is about the right price for them. It's this, 45 billion, 15x earnings, and that's about right. So I'm happy with them here. I'm happy though, in this case, to sell the 180 puts. I feel good about 180. I'm selling for 22, so my net entry is 158. I definitely like them at 158. That's 40% below this price. So do I like 158? Yeah, I think 40% below the top is a good price. And it wasn't a spike top. It lasted. So there were plenty of people all along this 3-month window that felt that their numbers were justifiable of around 200 plus of a market cap up around here, which would be about I'd say about $60 billion. Now, $60 billion is 20 times their actual earnings. That's possible, but not. It doesn't make me excited. It's not terrible, but it's in there. So I could see people doing that. Now we're talking about netting in at 150, 158. That's going to be more than 10% below this price. So we're talking about a P of roughly P of 15. A P of 15, I'm happy to spend for Federal Express. That's fair. So I don't mind owning it for that price. So that's the logic of doing a trade like that. And got to go in 5 minutes. So let's take a look. SGYP dead. Who cares? We looked over the short-term portfolio. That's doing its job. It's up a bit. It's up only $12,000 though. The long-term portfolio. Let's see how. Now we're bouncing back. So who knows? Long-term portfolio. Dun, dun, dun. So the long-term portfolio is now at, that's down a bit, 70. Now it's down to 76%. See what that is in money. So 883,000. So it was at 9 something. So it's down probably. So while the short-term portfolio is up 12,000, long-term is down 50. But that's because we have long-term hedges, and they're not going to show any kind of real profit until the market stays down for a while. Meanwhile, we're betting it's going to bounce back up. So if it bounces back up, the long-term portfolio stabilizes, and now we've made the short-term portfolio less bearish. So it'll keep its 250,000, which will then bring us to a brand new high total because we've got less hedges and the long-term portfolio recovers where it was. So that's what it's for. That's what the hedges are for. The hedges are for the long-term portfolio goes down 50 in my logic as well. If it stays down this much, then those hedges are going to start paying off more and more as time goes by. If it doesn't stay down, then we didn't need the hedges. So you've always got to balance. So you've always got to look back and forth and balance things out. Microsoft, we got less bullish on Microsoft. We expect them to pop. We have the short 115 puts, and they're currently think about the short-term portfolio. We had a whole discussion about this too. So we got the short 115 puts, and we sold them for $5. So really, our break even on these is 110. So it's Microsoft's over 110, and I'm betting they're gonna hold it. I think they're gonna hold this line and go a bit higher. And the higher they go, if they go to 115, those puts expire worthless. Now the short puts were from 120. We cashed those out just now for $10. Because on the spread, it's a 110, 115 spread. If we keep the spread, we're going to make $5. So half, which is $20,000, half of our profits will disappear if we let the spread expire in the money. But by doing it this way, we have a chance to pull $60,000 out of the spread. So I'm willing to take that chance. That was the basis of that logic. I think we have a better than 50-50 chance of making money as Microsoft comes back up here. And again, because Microsoft makes a ridiculous amount of money, they're a company in great shape, and they shouldn't be down. They just fell down with the market. And look what happened when they fell down with the market here. They fell down with the market here, but this time people are like, no, I'm not going to 100 again. And people started buying because the people who missed out here were not willing to wait. Other than that, though, we didn't really change anything in the STP. As I said, we added the MJ trade over there, and the other one we added was Celgene, also a loser from the short-term portfolio, and now we're adding it to the long-term portfolio. And with Celgene, we're not, when it bounces back, we'll sell some calls, but right now we have a 60-80 bull call spread, so it's a $20 spread, $40,000. We're selling the 70 puts, which are quite a bit out of the money. And, I didn't have a thing on Celgene. Where are they? That's not it. That's not it. Where are these charts? FinViz. Oh, that is it. Sometimes there's not much out of the money. It's right at the money. But this is, we're at a point in Celgene where I consider it a very fair price. And I think we're lucky that we have the opportunity to buy it down here. So we're selling 10 of the puts for $70. And let's go back over here. I'll do a quick look. I mean, again, steady 11, 9, 11, 13. And now let's see quarterly if it's holding up. Are they going to do better than 13? Yeah, here's 7, 14 there, 14, 15 pace. So they're adding another $2 billion this year. Oh, profits. I guess we should look at the profit. And then the profit is cranking along. We're looking at a $4 billion pace of profits. And last year they made... Oops. See, they paid normal taxes. Last year they made $3 billion. This year they made $4 billion. The year before they made $2 billion. That seems nice. And how much am I paying at 70? $50 billion. So again, we're back to I don't mind paying $50 billion for a company making $4 billion. And especially when it's a biotech company with lots and lots of potential for new products. Biotech's the future. It's almost as good as marijuana. This is the future, folks. This is how we're going to cure people from now on. This is going to be the old Pfizer and Merck and whatever, all that stuff is going to be dead, and biotech is going to be your cures for everything. So, pills are not the answer in the future. Biotech is the answer in the future. So, to me, this is a bargain. Why would you thumb your nose at it? It's crazy. So yeah, we absolutely, in a long-term portfolio, want to be involved in Celgene. So we're spending $8,000 on this spread. But we're in the money because we bought the $60 calls. It's a conservative play. We bought the $60 calls. It's at 72. So these calls are $12 to $20. These are $24,000 in the money right now. It was $23,000 this morning when we started. So they're not. So we made $1,000 already. So these calls are $12,000 in the money for $24,000. The puts are out of the money. These don't matter because we're going to make whatever is between these two numbers. And it's a good little business. Why would I not do this? And I said to you, don't you love options? I mean, $8,000 to buy a spread that was $23,000 in the money. It's just, they're just giving money away. If you bought the stock, you would buy the stock. And this is, again, people say, oh my God, what about these puts and what about the margin? I'm like, this is a play for somebody who has $70,000 to buy Celgene with, which we do in our long-term portfolio. It is not a play for someone who doesn't have $70,000 to buy Celgene with. And so, and that means that it should be no more than 10% of your portfolio. If you don't have $700,000, you should not be making a play like this. Do 5, do 2, whatever. I mean, you've got to be proportionate to your thing. No trade should ever end up assigning you a position that's going to be more than 10% of your portfolio under any circumstances. And of course, it's not likely to go bankrupt. You're not going to lose your whole $70,000. Maybe it'll go down to 50, and you're going to lose, in this case, 20. Even at 50, well, I'm sorry, at 50, you would lose $40,000. No, I'm sorry, you wouldn't. I apologize. At 50, you would lose 10 times 20 is $20,000 plus the 8,000 you put in, right? So you lose $28,000. That's what your risk is if this thing drops significantly. If this drops 30%, your risk is $28,000. It's not $70,000 at risk. You have to be realistic about what your risk is when you have a position. But you still have to say, I could lose $28,000 in this position. So if you don't have $28,000 to lose on a single position, don't do it. We've been doing a long-term portfolio. $28,000 is not even our allocation blocks are $100,000. So we're not worried about losing $28,000. So we're going to play it aggressively. We're going to take the very low calls, the very low calls that we'll buy. We'll spend $8,000 to be in the money because we can afford it. And it also puts us in a great position to sell. So if it comes back at 80, 85, we'll start selling some $90 calls and pick up a few thousand here and a few thousand there. And before you know it, we're adding 10 or 20,000 more dollars to this trade. That's how you make money. You just have a dozen positions like that and grind out the cash over time. It's not that complicated. It really isn't. It's like instead of speculating on stuff, just take some solid, good positions like this when they come up. But this is why you have cash on the side, because when the market dips, you have these opportunities. Now, we lost, by the way, I think I mentioned that. We already took a loss in the short-term portfolio on Celgene of $7,500. So we took that losing position, and now we moved to this very aggressive long-term position. So when we make our $32,000, we're really making less because we've got $7,500 that we already spent. So we're going to make about $25,000 all told. But that's fine. It only started as a $500,000 portfolio. If we have 20 positions, make $25,000. That's 100%. We're good with that. Remember how much money we made with 20% compounding year after year? Imagine you compound 50% year after year. You don't have to imagine it. We have the thing. Here it is. Look. So we take a $500,000 portfolio and we compound it at 50% for 20 years. Whoop, nope, did it backwards. 20 years, 50%. And that's going to work out to, that's billion. No, it's not billions, millions. Wait. No, that's billions. That's $1.6 billion. So if you want to be a billionaire, take $500,000 and for 20 years, make 50% a year and then keep reinvesting it. That's all. Very simple. So what I'm saying is, though, this position is on track to make 50% a year. But against your margin and cash that you're putting into the trade. Obviously, not every position is going to make that, or we'd all be billionaires. But if you have 20 positions like that and you're hedged against a downturn, and in a good year you do make 50%, in a bad year you might lose the cut 10%, you'll average out to 20, 30, you average out to 20%, maybe 30%. And if you can do that, if you can keep your average up and not take too many losses, which is all Warren Buffett ever did, and all Warren Buffett ever did is average 16% a year, but he did it for 50 years. So if you take $500,000 for 50 years and average 16%, that's $1 billion, $835 million. That's how you become a billionaire. He took whatever. I mean, he took $50 million and did that. Or $5 million and did that. Sorry, he took $5 million, or whatever it was, and then that added a zero. Right, that adds a zero, so he's got $8 billion. No, actually he did. He probably had about $50 million and grew it for 50 years at 16%. That's where his money came from. He started with $50 million. That was good, but the point is he grew it to a huge amount. And that's what we're doing in PSW Investments. It's a slow, annoying grind at the beginning. It's what we're doing with our hedge fund too. We're establishing these long-term positions, and over time they snowball. But the first year, not very impressive. The second year, not very impressive. But you get into the third, fourth, fifth, sixth year, all of a sudden it's like, oh my God, I want to get involved in that. But you can't because it's too late. It's already up that much. I mean, yeah, you can always get in, but you'll never, its returns just snowball over time. But the first year or so, you have to position things. And that's what we're doing in the long-term portfolio. We're positioning for future growth. We're getting these deep value stocks. And when there is a positive market, and one day there will be a positive market, when there is a good positive market and things move higher, we're going to be there for it. And then we cash out. Like we did last year. Last year we said, you know what, this is the end of the glorious rally. And we cashed all our portfolios out, and this year we started with all new portfolios. And already they're doing quite well because this year went better than we thought it was going to go. But that's all it is. It's just a cycle. Sometimes it's up and sometimes it's down. And when it's up, make sure you have cash so you can buy things. And when it's down, I'm sorry, when it's down, when it's up. When it's down, make sure you have cash to buy things. And when it's up, make sure you sell things so you have cash to buy things. When it's down, it's not complicated. It is not, really. People ask me for investing advice all the time. I'm like, I mean, come on, it's common sense. Buy things that are cheap. Sell things that are expensive. Wash, rinse, repeat. That's it. But you got to know, you've got to understand the value. And that's we talked about that at last week's thing, is that you've got to understand the value of the things you're buying. I'm buying Celgene at 70. When Celgene gets to 95, I'm going to question whether or not we should hold it. I'll say I like Celgene, but I wouldn't pay 20 times earnings for them because there's this risk and that risk and that risk. I'll pay 15 times earnings for them. I won't pay 20 times earnings for them. And so if it's over 20 times earnings, I got to say, you know what? Why don't we just get rid of it? Same thing with Apple. We sold a huge amount of Apple, and Apple hit 230. I was like, that's it. It's too much. Why would it? 204 was $1 trillion. 230 was $150 billion more added to the market cap. I'm like, what did they do to deserve $150 billion more dollars? Nothing. So I predicted it would fall back to 184. It actually fell back further. It's down to 170 now. I still think it'll settle down about 184. But 184 is the right price for them, not 204 and not 220. Not now. Next year, if the sales aren't a disaster like everyone's predicting, next year they'll be worth about 200 and something. They'll be $1 trillion company next year solidly. But right now, no, they're not $1 trillion company. They're making $50 billion a year. You multiply that by 20, that's $1 trillion. The market's a little risky. There's uncertainty. There's competition. So less than $1 trillion. Less than $1 trillion is below 204. So above 204, they shouldn't be. That's it. I don't have a complicated view on this thing. I don't have all these complex formulas for stuff. I'm just telling you that's very simple to value a company. What do they actually make? What is their potential to make more money? What risks are there? What competition is there? What things are in their way? And then you have to weigh it out and figure out where you're comfortable with the zone of value. Oh, I see the market's pulling back. All right, well, again, all stuff is bullshit until we see where it finishes. So it's a question of where we finish the week. So we'll keep an eye on it. I'm leaving now. I'm going to run out the door, in fact, right in a second. Takes us closely, but if we end up, if today ends up flat again, then there's really weird stuff going on. Because if we go down, we come back to flat. If we go up, we come back to flat. That means there's some very strange things going on in the market. We'll have to figure that out tomorrow. All right, but thanks for coming today, and we'll do it again. Oh, somebody said they can't see the screen. Well, it doesn't matter. It doesn't matter now. I'm shutting it down. All right, guys. Anyway, we'll do it again next week, and I'll be back at the command center. So we'll be having a normal 2-hour webinar. All right, take care, folks. Bye.